Good morning, good afternoon, good evening, wherever you are in the world in this week of early August. I'm Nicolas Véron. It's my pleasure to introduce this summer session of the financial statement series at the Peterson Institute. And today we will once again talk about supervision in the United States. This looks increasingly like an obsessive concern of the series because it's the third session in the limited amount of time that is devoted to this topic. We had Dan Tarullo and Sarah Bloom-Raskin on April 26th, and we had Peter Conti-Brown and Rosa Lastra on June 14. And today, of course, Mayra Rodriguez Valladares and Stephen Kelly to talk again about what the episode in March has revealed about banking prudential supervision in the United States, and really whether we should worry about it. The reason there is this repeat feature is that I worry a lot about it, but maybe I'm wrong. So I'm looking forward to learning a lot more today. Mayra Rodriguez Valladares studied at Harvard in Russian and Soviet studies. She graduated in 1988. She then was a Wallenberg Scholar at the Hebrew University of Jerusalem on Middle East conflict resolution in the late 80s, and worked at the Federal Reserve Bank of New York in the early 1990s as a foreign exchange analyst. She then went back to study at University of Pennsylvania at the Lauder Institute. She got a master's in Eurasian studies in 1995. She simultaneously got an MBA at Wharton, and then spent a few years in the financial industry at JP Morgan, at BT Alex Brown as an analyst. And then in 1998, exactly 25 years ago, Mayra, you founded MRV Associates, which is your consulting operation, and has been very active and successful in leading projects particularly with supervisors, and particularly with US supervisors, the Federal Reserve Bank of New York, the FDIC, the Securities and Exchange Commission, the Commodity Futures Trading Commission, the FFIEC, the Federal Financial Institutions Examiners Council. Is that right, Mayra? Which is the umbrella organization of the bank prudential supervisory organization in the US, where Mayra does a lot of training for career examiners of banks, and also, of course, consulting in the private sector. Stephen Kelly studied at the Wisconsin School of Business, and he went into the financial industry as well. He worked at the American Family Insurance Group for a few years, then was at the Yale School of Management, where he got his master's in systemic risk in 2018, I think. And since then, Stephen has been one of the pillars of the Yale program on financial stability, which I think is one of the most prominent research groups in US academia on these kind of topics. So today we will really focus on supervision as opposed to the rule setting and also the crisis management. Of course, we will talk about regulation and crisis management, but we want to go into the dark matter of banking supervision and how really it worked or didn't in the experience that was revealed earlier this year. With that, Mayra, over to you.
Thank you very much. Really appreciate your very kind invitation of the Peterson Institute for International Economics, and delighted to be here having this very, very important conversation with Stephen and with you, Nicola. And I understand that the slides are going to be available later. I think it's important to take a quick look at this, and some of you may want to take out a magnifying glass. Banks are incredibly regulated. And of course, as with everything, it all starts with a law. Whatever the legislators, whomever they empower to regulate, matters a lot. As you see here, the Federal Reserve, the Federal Deposit Insurance Corporation, and the Office of the Control of the Currency are the key national regulators that regulate all of these different banks. And then you have a whole host of other securities regulators. You have mortgage regulators, and I won't have time to get into that. But it's important to note just all of these actors, and depending on where we've been on the economic cycle or what kind of crisis is going on, they don't always necessarily work together. They don't necessarily share information. And that in itself is a big reason why sometimes you end up with problems at banks. You may have one regulator who knows about a particular problem, but doesn't inform the others. Now, to be fair, in my professional observation, the Federal Reserve, the FDIC, the OCC have improved their information sharing, and they have a lot of meetings, but still there's a lot of room for improvement here. And you have the state regulators as well, who most unfortunately often do not have all the necessary resources to be able to regulate all these kinds of banks, the depository institution, as well as all the broker dealers and insurance companies. Now, there's a lot of blame to go around, to be honest. The banks failed because there was serious lack of risk management at the banks. Silicon Valley Bank, First Republic, Signature Bank, and at every single level. First of all, it's always, of course, in the first line of defense, it's the individuals who are running the different businesses. So especially with asset liability management, not paying close attention to the interest rate risk. Interest rate risk is not new. Interest rates go up, they go down, and obviously they're going to affect the value of your assets, both on the trading side and very much also on the banking side, which is where all these loans are, and they held to maturity bonds. The boards were being informed about this. They were included in every single examination report from the San Francisco Fed, from the state regulators. So where were the boards? They obviously did not take this seriously enough. And at every single exit, they're called exit meetings. So after the examiners present the CAMELS report, capital, asset quality, management, earnings, liquidity, and sensitivity to market risk, the CEO is there, the chief risk officer, chief credit officers. So these individuals were always informed. Silicon Valley Bank, for example, now what we've seen from the publicly available information, they were having problems back as far to 2016 with anti-money laundering types of processes. And then throughout the years, they were called out on models, they were called out on liquidity risk, on interest rate risk. So the CEO, all the different executives knew about this, the boards knew about this. And then where were the auditors, right? They're that third line of defense. So the first line are the people who actually work on the different transactions. The second line of defense are all your compliance officers, your risk managers, and then you have your auditors. And they too would have seen problems, and they too would have been seeing the examination reports. But regulation also matters. So when the Economic Growth, Regulatory Relief, and Consumer Protection Act was passed in 2018, and I know that this has been discussed so much, but it is important to mention again that this is when those banks that were under $250 billion in assets were no longer designated as systemically important. So that meant that now the tailoring rules that came under Mr. Quarles when he was the head supervision person at the Fed, those tailoring rules then focused on those globally systemically important banks like your Goldman and JP Morgan, but all the other banks ended up in sort of category 4, as you see here. And that would have been Signature, that would have been SVB. So that meant that they didn't have the frequent stress tests. Importantly, they did not have to measure or report the liquidity coverage ratio, which would have shown much earlier that they were having serious problems in how they were measuring how interest rate risk can very seriously become a liquidity risk. I mean, when you have something that's called economic growth, regulatory relief, right? That right there should have been the signal. And in fact, the IMF had pointed out that they were very concerned in their FSAP, the Financial Stability Assessment process. They had pointed out that this was going to be a problem, that these tailoring rules were going to be a problem. And unfortunately, nobody paid attention to the IMF. Barely anybody knew about that report, but there were signals all along the way that there was going to be a problem in that category of banks. And unfortunately, of course, there were also shortcomings in actual supervision. Normally, people hear about examiners and they don't really understand what they do. The examiners are not the regulators. They did not write the rules. They are part of supervision. So you have what's called off-site supervision. These are all the people sitting at the Fed, FDIC, OCC, and they get all of the quantitative regulatory reports. They get a lot of information about the banks all year round. But the examiners, they're the actual on-site supervision. So way in advance, they will arrange meetings with the banks. The banks get a list of all of the questions. If there were any problems that were called out, certainly SVB had year after year, there were problems being called out with their risk management, their models, their anti-money laundering processes, with interest rate risk management. All of that, the examiner in charge, who is leading this group of examiners, would inform the banks, okay, we saw this last year, how are you coming along? And so there's always this back and forth. Eventually, the examiners do show up and they can spend 6 weeks there, 8 weeks there, conducting what is called risk-based supervision, looking at market risk. So they would have looked at the change in interest rates and how that was affecting the banking book. They look at credit risk. What has happened since the financial crisis of 2007, 2009 is that now the supervision of large banks, both the systemically important ones as well as the large bank organizations, that's centralized at the Federal Reserve Board, but the hands-on soldiers are still over in the regional feds. In this case, it would have been the San Francisco Fed. We also have to point out, or I have to point out, that the FDIC had been CC'd on these examination reports, for example. They knew about the SVB problems as far back as 2016, and even the Consumer Financial Protection Bureau had also been CC'd in these CAMELS reports. So there's a lot of information still that has not been disclosed as to exactly, what kind of communication was going on between the Federal Reserve Board and the San Francisco Fed and the FDIC and the CFPB. Why did they not notify anybody else, or what did they do? Because they were receiving those reports that SVB and these other banks were a serious problem. And then there's also the state bank supervision, where we barely have had any information as to where the failures existed there. So here's a list of recommendations that I have made before. I'm not going to read them all out, but there has to be serious remuneration reform at the banks. So long as banks are being paid to take risk and CEOs can just march off to Hawaii without any repercussion, you're going to have to continue to have these problems. And I would definitely emphasize that there needs to be an independent investigation of the Silicon Valley Bank failure, for example, to get all of these missing answers as to exactly the relationship between the Federal Reserve Board and the regional Fed. Because when you look at those reports, the examiners at the San Francisco Fed, from what I can tell in my professional experience, they knew what they were doing. They called out the problems. So then why was there no enforcement? It's very important to remove the heads of the banks from Federal Reserve district boards. And you definitely need to require banks to disclose more information about their interest rate risk management. And that disclosure has to happen a lot more often than just once a quarter. I really look forward to your questions later on.
This is great. Thank you so much. Just a few questions about these recommendations for our audience. Some of them, am I correct that some of them require new legislation, but others don't, right? So can you tell us very quickly on that list of 10, which ones would require Congress to act?
Well, certainly number 3, right? So you need the S2155, which is that Economic Growth Regulatory Relief Consumer Protection Act, that would require legislative action, which, as we all know, unfortunately right now would be very, very challenging, especially in light of the fact that we're going into an election year. So that one definitely needs legislation, and so does the remuneration. And there have been and are a variety of outstanding proposals on that, some even going as far back as Dodd-Frank. And so those would need congressional action. Number six, requiring transparency from the banks. That actually is the SEC. In other words, right now, the banks only report once a quarter. Certainly, the bank regulators, the Fed, FDIC, OCC, could require the banks to disclose this information at least to them more often and in a granular manner through the regulatory reports. But otherwise, there's a lot right now that the Federal Reserve, FDIC, and OCC could already do. They could require more information about interest rate risk measurements, liquidity risk measurements. They can already do that, both under Basel III and also under Dodd-Frank. There is no reason why these big regional banks right now couldn't be required to be doing the liquidity coverage ratio, for example, which really is that interconnection between interest rate risk and illiquidity.
Right. And what about number 4, to reforms the governance of the Federal Reserve banks? Does that require legislation?
You know, that's a good question. I don't think so. I will have to get back to you on that. But that is something where certainly the Federal Reserve could be looking outside of the banks to populate those boards. Banking has changed so much, and even in the last couple of years. So you really, frankly, need other skill sets on those boards. You need
right.
You need IT, for example. You need cybersecurity. Frankly, having somebody who's head of the international crisis center,
right.
having a head of the Red Cross, somebody who deals with crisis all the time. Somebody like that at the board. You do not need a bank, especially one that's being regulated. You could have the head of an insurance company there. You could have a head of a securities firm.
So I look forward to seeing a firefighter as president of a regional Fed. That will be
frankly, that would not be a bad idea. These are the people.
Thank you. Stephen, over to you.
Yeah, thanks, Mayra. Those were great comments. And I want to get us to the Q&A. I'm just going to say a few things about really what we expect supervisors to both see and then also enforce. So I'm going to read, if you'll bear with me, I'm going to read just briefly from the Barr report on supervision, the postmortem that he put out after the fact, which says that the report, quote, concludes that the banking supervisors failed to adequately and proactively identify and police the weaknesses of banks. This failure was caused by many factors, including beliefs that financial institutions were capable of self-regulation and that regulators should not interfere with activities reported as profitable. So I've already lied to you once, which is that this is not from the Barr report. That's from the Financial Crisis Inquiry Commission in 2010. So this is really an evergreen issue that we see in the aftermath of financial crises, that it is impossible to get supervisors in a bank saying to bank executives, you're doing this wrong, and here are the costs, and here are the things you need to change. Not impossible, but this is a difficult issue. I mean, how do you say to a bank that's making money hand over fist that basically they're wrong about their read of the situation? And how do you back that up? And for all the flack that Quarles gets, both justifiably and not, he was very concerned with I think the latter part of that, which is having something you can show to banks and say, look, this is the grounds on which we are regulating you. It just makes for weak regulation. Actually, I should acknowledge Nicolas. Since I'm invoking the financial crisis here, I should say a happy 16th anniversary to all who observe. It's August 9th. 2007 is widely considered the beginning of the financial crisis. I can only assume Nicolas was intentional about that. But yes, this really is the evergreen issue that we always see in the aftermath of crises because we examine failed banks. And it's sort of the problem of only examining failed banks, right? If you walk into JP Morgan today, I'm sure there are things that supervisors are letting go. I'm sure there is some fraudulent loan somewhere in the bank. And this sort of leads us to misdiagnose too much of a banking crisis as an issue of micro supervision. So I just want to say quickly, what we know the supervisors knew was about the unrealized losses in these banks, publicly reported. Equity investors knew. You could read the Financial Times from February, from January, from December of last year, all sorts of shorts, sort of making their case in the financial pages. Uninsured deposits, some data manipulation notwithstanding, that's mostly reported accurately in call reports, widely known, as well as gradual, deposit attrition in the banking system writ large, really since early 2022. And so there's just lots of dogs that didn't bark here. There's banks that do fit into that mold of uninsured deposits and unrealized losses that we really didn't see issues with. And so what additional information did supervisors have? Well, a lot of hay has been made about SVB having 31 supervisory MRAs, matters requiring attention, which, of course, is getting a lot of attention. It looks like a disaster. And it seems like the main enforcement was that the bank failed. There was a lot of issues with enforcement. You get the Fed report that basically says, our supervisors were not forceful enough. They weren't really taking this stuff seriously enough, moving quickly enough. And we get a similar story from the FDIC and the NYDFS with Signature, which had 13 outstanding, the FDIC equivalent of MRAs at the time of its failure. First Republic had 0. So this is sort of complicates the story. This is not just a story of scaredy cat supervisors unwilling to, take issues to the front of the bank. First Republic had very clearly, just as many uninsured deposits. It had worse unrealized losses and, 0 matters requiring supervisory attention. So that's something that challenges, again, the narrative that this is just, supervisors who are sort of shaken in their boots. What was not known, by the market, by the public, really anyone except for the bank and potential equity investors who ended up not, funding SVB, was the true state of the deposit franchise. That sort of infamous cash burn that SVB noted in early March that started their run. Depositors can be as loyal as they want if they don't have any money. If they're running out of their own money, there's nowhere to put it. So the point being that, all financial crises are macroeconomic events, and there's always going to be an early pinch point. And, so Lehman would not have happened without Bear Stearns. Bear Stearns wouldn't have happened without, BNP Paribas 16 years ago today, which wouldn't have happened without et cetera, et cetera, et cetera. And so, undue focus on the early pinch points, I think, makes us look too narrowly at some of the issues here. And you really can't do ex post facto balance sheet analysis and try to get to the bottom of it. You have to really look at what was happening in real time. And, what the supervisors and the Fed in general kind of missed here was the macro of it all. And really that tech, and a tech bank was going to be the first to get pinched. You have the Fed on the one hand saying, we're trying to tighten financial conditions. We're thrilled when the stock market goes down. We're thrilled when credit spreads go up. Crypto, goodbye. And then a bank, also part of financial conditions, fails and they want to put a head on the pike, right? And that was really the case of the left hand not talking to the right hand. And then we're bringing the California State Bank supervisor to Capitol Hill and saying, what went wrong? Why did 2 of the biggest failed banks in history happen in your state over the course of 6 weeks? And also, what's your name, by the way? That just can't be the solution. This was a very real macro story in tech, and the Fed was causing it and basically just missed it on the supervisory side. And so, this is hard, and I don't have a perfect model for this. Like I said, this is an evergreen challenge to really incorporate more macro into the supervisory side, but also address issues bank by bank, with capital and having the ability for supervisors to go into something like SVB or Signature and say, your business model is at risk because of the macro and you need to hold more capital. It's 2022, it's late 2021. You need more capital. And, our macro expertise says that's the way we're going to go. Some of this gets captured by the new operational risk charge, which sort of catches, past losses a little bit. So some of the, mess ups and stuff could really be captured in capital. And I'll just sign off, Nicolas, with a line from Barr, which didn't make it into his most recent speech, but was in his testimony, where he said that, for today, for example, the Fed does not require additional capital or liquidity for banks with, inadequate capital planning, liquidity risk management, or governance and controls. Higher capital can serve as an important safeguard until risk controls improve. So this should be a catch-all going forward. And I'll leave it there.
Mayra, you mentioned that exact same sentence from the Barr report in one of your congressional testimonies, I think. Can you give us a bit more context on what exactly is the discretionary capacity of the Fed to impose additional requirements when they see, risk control failures or weaknesses?
The Fed definitely has a lot of power, and we have to remember the FDIC and OCC as well, right? They all regulate these banks. One thing I need to make sure is clear is that it's not just about capital. Capital, of course, is there to help sustain unexpected losses. This is what it's all about. But the Fed definitely has the legal right to impose additional risk management requirements. It can impose liquidity requirements, interest rate risk measurements. I mean, the guidance for interest rate risk management has been around for decades. If you go to the OCC and the Fed's sites, there's plenty of publicly available guidance there. So no bank can say that they didn't know how to do this. And the Fed can also require specialized exams. So every single year when these matter requiring attention and matter requiring immediate attention were coming out, they certainly can send in examiners and say, okay, we're going to just, really focus on this particular area. So that we don't need additional legislation for additional capital or liquidity requirements, because all of that is already there. It's a matter of enforcing it. Now, the bank examiners, if you read those CAMELS reports, they knew what they were doing. They were calling out, the minute that you call out a process for anti-money laundering, that is serious. If a bank can't even get that right, that's an immediate red flag of, wait a minute, this is the kind of thing that invites attention, not only from the regulators, but from the feds, right? This is serious.
But we have a question, for example, from Zipper Grossi, who asked, you say the examiners got it right, but when you look at the overall composite score, the CAMELS score, they never fell below 2, which means fundamentally sound for Silicon Valley Bank and Signature Bank. So is it really the case that supervisors understood the issues if they weren't able to say these banks have a serious problem in terms of the holistic rating?
Your point is a very good one. The score. See, what happens is, the examiners go in and they have different tasks, right? They've got to look at liquidity risk. They've got to look at interest rate risk. They've got to look at capital, right? It's all risk-based supervision. Then they are submitting their observations and recommendations to the examiner in charge. Then this has to move up, right? It's got to go up to various middle managers of the Fed, all the way to the senior. And then the report actually ends up going to the bank. And so what I firmly believe is that there was some serious intervention there between the time that the examiners called out the problems to where those scores came out. You're absolutely right. And that.
So is there anything in the documentation that was released by the Fed together with the Barr report that allows somebody who knows the system very well from the inside, like you, to understand where exactly those interventions may have happened? Also, I mean, who has the last word, right? I mean, who actually signs off on the CAMELS score of a bank like Silicon Valley Bank?
Well, that's a great question. I mean, there's a real disconnect between what the examiners wrote about the different problems that they were identifying every year and the score. I agree with you. And that's the first thing I noticed. This makes no sense. And unfortunately, in the report, it doesn't tell you about the process, right? It doesn't tell you, okay, this now goes to the examiner in charge. Now it's going to go to higher ups, all through the Fed. And it doesn't tell you, oh, by the way, this report is going to be sent over to the board. And that's why it's very important for more information to be released. I don't think that the Barr report should be the end of it. There's a lot that's still missing there.
That's a very important point, and it echoes what you said about the need for an independent evaluation, right, Stephen?
Yeah, I was just going to say, I mean, in theory, Barr, once he was in the job, has the last word. Certainly with big actions, they're not going to fine SVB, $1 billion without it crossing Barr's desk. And another thing we see in history is reticence to make things public. You downgrade a bank to 4 or 5. You elevate the supervisory to a consent order, and suddenly things are public, and there's a real fear that that's going to cause a run. I don't know that that's really borne out. I mean, look at a bank like Credit Suisse, which lived for so long with so many very apparent issues. Deutsche Bank, Wells Fargo's had an asset cap since 2018, and people still bank there. So, but that is a real barrier. Is what do you take public? And now we're in the classic situation of, okay, well, now the financial system's fragile, so you don't want to do anything too public now. But we sort of missed our opportunities in maybe 21, 22 to do that.
Wait a minute, Stephen. I cannot let that without a follow-up. You say a lot of financial institutions are fragile, but the Fed and the Treasury say the system is very sound, the deposits are safe. So can you elaborate on this? What makes you think that this is not over?
So I guess I would say both are true. I kind of have a oxymoronic assessment, which is that the system is stable but fragile. For those who watched Veep, it's kind of like continuity with change. But we're certainly in a more fragile situation than we were in February. Obviously, the longer rates stay higher, the more the more funding structures get pinched. We've seen a lot of funds, become more expensive for banks. They're now sourcing them from money market funds instead of low-cost depositors. Things like that. General awareness of the banking system and risks is up. I think there's still, upside risk to interest rates, and then we'll see what happens with credit, CRE and other assets like that maybe get pinched.
Commercial real estate.
Yeah, I agree with Stephen in the sense that, yes, your really, really big banks are well capitalized, they're liquid, but there's all of the other hundreds and hundreds of banks. And I've been arguing for months that my biggest fear had been that the regional banks, which by definition are concentrated, that's something that they know. They know they're concentrated both on the asset side and the liability side. So there's no excuse why they were seriously mismanaging their very basic function of asset liability management. But my concern has been that we move from this interest rate risk to credit risk, because we have very, very elevated rates, not just in the US, Europe, UK. You had over 90 central banks last year that raised rates. So you have a lot of different banks with loans on their books, especially those office loans, but in other sectors of the economy where the loans have already deteriorated. Lots of different companies have defaulted. And unfortunately, we have not seen the end of that yet. So there's a lot to be concerned about with those banks that are below the globally systemically important bank size level.
Yeah. And sorry, Nicolas, let me just draw a line under this. I want to be clear.
You won't be able to draw a line because we'll have other discussions about it, but go ahead.
Well, I just want to be clear. I mean, one thing from the start, and we're not going to, I don't think we're going to stray too much into the interventions of March and May, but this was never that feeling really of, this is going up the dominoes are going up Wall Street. It never has that. It still does not have that. We're not looking at Goldman, and it doesn't have that 2008 feeling. I just want to be clear about that. It's not, the dominoes aren't going up like they did in 2007 and 8.
Time will educate us, I guess. I'd like to come back to this issue of the division of labor within the Fed system. I'm a bit less ignorant about the European system, and they have this very public disclosure of how the responsibilities are divided within a joint supervisory team, with the last word belonging to the team coordinator. publication of dissenting opinions to not to the public, but to the supervisory boards, and the decision made by the supervisory board, which is proposed for approval to the governing council, tacit approval, and all these kind of internal steps. From what I'm hearing from you and reading from a lot of reports, it seems that the Federal Reserve doesn't really have that kind of public explanation of how they make decisions internally, or is it just that I missed a document that explains, the respective roles of the regional feds and of the board and of the examiner in charge and of board staff in Washington in that supervisory process?
No, you didn't miss any documents. I mean, if you go to the Federal Reserve, it does tell you about it explains a little bit about the history of the changes so that you have sort of a level of centralization. And as Stephen mentioned, right now it would be Mr. Barr, where that it oversees all of this. So you have the LISIC, which so that's your Goldman and JP Morgan. Those are those large, systemically important banks. But then you also have the large bank supervision, but there isn't a lot of disclosure as to how do they send information down. You know that the key reports are going from the regional feds up to the Federal Reserve Board, but there's not any disclosure as to exactly how this operates. And so frankly, I've met regional bank examiners who themselves remain unclear because they're very focused on the orders that come in from the regional Fed, then the examiner in charge, and they just go do their work, right? But what then happens to that information? How often is it sent over to the board, or how does the board then direct this? That's not clear to a lot of people. So it's not just you, Nicolas, who hasn't found more clarity in this at a public level.
Is that specific to the Fed because it has this complex structure with the regional banks, or is there? And if you look at the other agencies, the state regulators, the OCC, the FDIC, do they have more clarity in terms of their internal decision-making process, or is that a generalized feature of the US supervisory systems that they don't say much about how they make decisions?
Well, with the state ones, that's a simpler thing because by definition, they're just looking at banks and insurance companies, broker dealers in their state. So everything happens within that organization, and they don't have to liaise with others. So that process is actually simpler. Now, the FDIC and the OCC do have regional divisions, not as much as the Fed does. But you don't have a public document out there, outlining all of the steps as to the information from the head office down to the regional entities or back. So there's not transparency.
In terms of the CAMELS ratings themselves, which obviously are a key aspect of the process, does the same kind of black box observation apply? Is it a decision of the Federal Reserve, or do we know more about, the sign-off for CAMELS ratings?
Well, the CAMELS are done by it all starts off with the information that is being collected from the examiners, to a certain extent, some of the offsite supervision. And then that has to, be summarized in a report that the examiner in charge has to then put together, and then it's being sent up above to middle level managers of the Fed, senior managers, and then it also gets sent over to the board of the relevant bank and the CEO there. And so if they have a problem with that, rest assured they're going to come back and try to influence that process. That's another reason why it's absolutely critical that you don't have the heads of these banks at the Federal Reserve boards. I mean, that's just, it's very difficult to call out a bank when you've got the CEO that is right there. Now, Stephen made a point earlier about how, we only examine banks when they failed. I have a different view on that. Banks are constantly being scrutinized by offsite supervisors, by the examiners. You also have ratings analysts, you have bond analysts, you have stock analysts. So there's all kinds of observations and analysis of the banks. Now, I think the problem is that the banks push back a lot. They spend a lot of money on their lobbyists, which hasn't been mentioned yet in this conversation, which is important. And so in the good times, it is hard for offsite examiners or examiners to really be forceful and say, look, we see these interest rate issues, we see these liquidity issues, because of course the CEOs say, what are you talking about? We're making a lot of money. And then by the time there's a downturn, right, then I do agree with Stephen that a lot of actors would say, oh, no, this isn't the time to impose additional requirements. And we really have to change that. It's exactly in the good times that you've got to remind people not, to stop the excesses, because on the way down, it's everybody else who ends up getting the hangovers and not the CEOs and executives of these banks. It's a real problem that needs to be rectified.
And Nicolas, to your question, and this goes back to Mayra's picture of the web, which is really that, as far as who knows about these numbers and who's signing off, the agencies are going to talk to each other too, and they're going to say, hey, we're thinking about downgrading them to a 3, we're thinking about changing them to a 4. And another agency that also has supervisory oversight is going to say, don't do that. Don't make us look bad. We still have them at a 1. We have them at a 2, whatever. So that slows down the process as well. Is the different, all the cooks in the kitchen can slow that process as well.
When you see the report that goes to the board, very important, it was a joint examination report from the California regulator and the Fed, and seeing the FDIC and the CFPB. So lots of cooks, as Stephen said, all knew what was going on, but didn't enforce.
It's actually one of those things that strikes me in the Silicon Valley Bank story is that I haven't seen much discussion about the absent role of the FDIC, but the FDIC in their publications, which by the way are very good about forensics about past crises, they often insist on their backup supervisory roles that allows them to keep the other supervisors honest. They like to say that specifically about the OCC, and the fact that basically if a supervisor, particularly when a bank is failing, if a supervisor is not willing to recognize that the bank has no future, is tempted to apply forbearance, the FDIC is there to say, well, if you don't do it, we will do it, and you will look stupid. What's your sense of why they weren't able to, push the Fed to be more proactive on Silicon Valley Bank at the FDIC?
In my view, this is really why we need a serious, independent investigation of exactly what happened. And the media has not covered at all that the FDIC and the CFPB knew there were problems. Now, the FDIC is serious. They were receiving those reports since 2016. They're the only entity in the United States that's legally empowered to do the cleanup, to do a resolution. So these are exactly the people that don't want a bank to fail, because they then are going to be stuck with a problem. But we don't know what the FDIC said to whom, what did they do with all that information? And that is something that really needs to be investigated.
And it's important to remember too, that without any emergency authorizations, the FDIC's interest is the deposit insurance fund, which was never really at risk with, a no emergency authorization SVB, 93% uninsured deposits. There's plenty of assets there, to protect the FDIC's 7% layer. Obviously, once you invoke the systemic risk exception, it's a different story. But
and they did that.
Right, exactly.
And they did that unanimously, if reporters are right about it. So in a way, it's egg on the face of the FDIC as well. And Mayra, you said the FDIC is serious, and I agree. But in their report on signature banks, they say, well, we couldn't really do our job because we didn't have the money, we didn't have the resources. So what did you make of that?
Well, when I said they were serious, is that they take their job seriously, that they don't want banks failing because they're the only one that can do the resolution. As far as the issue with not having enough personnel, that, yes, all the regulatory entities have a problem, which is, because there has been so much demand for their kind of skill sets in the private sector. And of course, the private sector pays more. There's always that challenge. There is always that problem. And so you do really need to pay these examiners more, but you still need it. You need the enforcers, and the whole structure is not set up at a regulatory entity for people really to stand up and say, wait a minute, I've been telling you that there's problems with this bank for 2 to 3 years. Why aren't you enforcing? It's not like you get a bonus. There very much, unfortunately, still is a don't rock the boat kind of mentality. So if you pay people better, then that might incentivize. If you tell them, that could be, a way to incentivize them to call these things out. But you also really have to make sure that if the board is going to be the one that is going to continue to have this level of centralization, they need to step in and make sure that these aren't just some comments in a Camel report or a score. They need to enforce, and they should especially do that when times are good, right? 2021, 2022 was really the time to remind people that interest rates go up and they go down. That is just one of the most basic things. And all regulators on both sides of the pond have a lot of publicly available information about.
Yeah, that's what makes it so infuriating in a way, is that it was so basic, right? I was talking to a foreign journalist yesterday who was telling me, the great thing with Silicon Valley Bank is that I've been covering financial crisis for many years. This one is so easy to explain. I can explain it to anybody. My readers understand what I'm talking about. Right. It's not like complex instruments or some alchemy. And this sense of supervision 101 failure is really one thing that distinguishes it from some earlier episodes, no?
Yes, and also the other thing that's important here is the SEC. I mean, the Silicon Valley Bank was measuring their interest rate risk and reporting it on their financials. They were doing a more sophisticated economic value of equity. And then in 2022, in that annual report, that disappeared and nobody called them out on it. And so again, you have to have a level of standardization as to how is this information supposed to be reported in financials and more frequently, because that way you can have lenders, bond investors, and stock investors get a hold of that information. It should be the bank regulators or examiners, who are on top of it, but you need that market discipline, but the market cannot discipline if it's not getting the relevant information, and frankly, more frequently.
Right.
I want to push back a little bit, because I think too much. I think this is sort of a subplot. The unrealized losses and things mattered once SVB shows up to market with its 8K and says, look, our clients are going to cash burn and now we have nothing to sell. Certainly it matters more, but like I said in my earlier remarks, I mean, you can look at a bank like Schwab or, places like that have really negative mark-to-market equity that are so far okay. Bank of America has $100 billion in unrealized losses that it's never going to see. I mean, so there's that's an important point, and it matters for SVB. It matters a little less with Signature. It mattered a lot with First Republic, which had 0 supervisory MRAs, as I mentioned. But it's once the run is on that really started to matter. It's not that investors saw this all of a sudden in March. They were talking, like I said, they were talking about in the financial press for quarters on quarters, and the stock traded at $280. And there's a nice chart in SVB's 10K that says here are our mark-to-market losses, and relative to our equity. So there are reasons for held-to-maturity accounting in banks, and there are banks that can really withstand those kind of losses and still make sense to invest in. A Silicon Valley bank maybe doesn't so much.
How do you explain that market discipline worked so poorly with Silicon Valley Bank, Stephen? As you mentioned, the equity share price was still very high at the point when a lot of information was out there showing that the bank had unsustainable features. So is it just that the market is generally dumb, or was there a specific elements that made it non-functional?
Yeah, I would say even zooming out from banks, all kinds of firms unprofitable firms get funding and get equity support, right? How long did Amazon have a great stock price before it made a cent? Uber, not that that's what Silicon Valley Bank is, but the point remains, you value a business on a go forward basis. And there's a lot of reasons to put equity in to a bank that's got a strong business model. And when SVB comes out in March saying, look, this tech downturn, which stands to last for a while if the Fed stands pat, is really burdening us more than we thought. That's a situation where, and by the way, we tried to raise equity and couldn't do it. We took this information to potential equity investors and they said no. So now we're going to market and issuing the AK. That's bad. I mean, it's the same with Credit Suisse. They basically have one investor left. Then he goes on the news and says, absolutely not, to no more money.
Yeah,
and
that was
the firm
memorable.
blows up. So, there's a lot to consider there too. How much enforcement is already being done by the equity market? And, then you start talking about uninsured deposits. How much enforcement do we need from them if the equity market's already covering it, et cetera, et cetera? We don't need to get into that necessarily.
I want to make a point. I want to make a point here that on this point, I don't agree with Stephen. And that is that interest rate risk management and asset liability management are the cornerstone of running a bank. And so that's exactly the job of the risk managers within the bank, to always remind everybody in the bank that you have to be very, very careful about interest rate risk management, precisely because it can lead to illiquidity very, very quickly. You're trying to get ahead of the run on the bank. So it's not that interest rate risk management and the held to maturity securities mattered after the run. No, this is exactly what you want to be managing ahead of time. Secondly, it's one thing to talk about Schwab and Bank of America. These are huge, very, very diversified institutions. So with regional banks and community banks, one has to be even more careful because they have a concentration both in their assets and in their liabilities.
That's right.
That's why it matters so very much.
I think both of you are right. I want to come back to this issue of remuneration of the examiners that we discussed about the FDIC. Mayra, does the FDIC have the ability to raise remuneration for its examiners, or is that a congressional matter? I mean, what is the obstacle here?
Good question. It could certainly charge the banks more, right? And the banks are going to fight back, but it could certainly.
So basically, when the FDIC writes in their report, we didn't do our job because we didn't have enough resources. Follow-up to that is we didn't have enough resources because we didn't want to take more resources from the banks.
They didn't explain that. And I have worked with FDIC people for a very, very long time. Those individuals are smart. They're well-trained. There's constantly training of these various examiners. Right. So I think we need to be careful, that these are qualified people. You don't just show up and you become an examiner. There's a whole sort of almost apprentice.
My comment was perhaps a bit too glib, but it was about the report, not the individual.
No. I'm just trying to provide my, personal experience with these people. But I think they do need to be paid more, and they need to be incentivized, and that has to come from raising premium on the banks. See, there practically is there's just no repercussions, right?
So to be clear, the FDIC doesn't need an authorization from Congress or from anybody else to solve its resource problem?
I don't think so. Not in this case. No. And because they should be able to raise the money from the banks. And when you can also use not only the money from the premium, but you also can use funds from fines and things like that. I mean, this is a broader problem. This isn't just the FDIC. These are all the regulatory entities, as well as the states. The states have even fewer resources, and that is more of a problem, because then that has to go through the whole legislative, the whole tax appropriation. But this isn't just about the money. It's about that whole layer of middle management and senior management. People should not be afraid to call out the banks and enforce. The problem is sometimes you have regulatory capture, right? There are individuals who may just be biding their time. They don't want to rock the boat, and then they can go on and get a much much better job, better in the sense of higher paying in the private sector. So regulatory capture is also part of the problem, and we need to call it out.
We have a few minutes left. So I apologize to Alexandra Barrage because she's asking about the, again, regulation versus supervision debate, and mentioning your colleague Greg Feldberg, Stephen at Yale, who has been writing that tailored liquidity rules didn't cause the failure of SVB. The reason I didn't push forward that question, Alexandra, is because I really want to focus this session on the practice of supervision, because there's been a lot of debate out there on the issue of the rules and the tailoring. But back to the supervisory failure, let me try to conclude with a big question on collective accountability. I mean, to my knowledge, nobody in the different agencies have lost their job following the events that played out in March. I'm not saying that they should have. I'm just curious about your opinion in terms of the general issue of accountability. And by the way, I mean that as going all the way to the top. So is there enough accountability in the system? Is the fact that there is this, observation, does that set the right incentives for the future? How should we look at this issue?
Well, we definitely need more accountability, and we need to start off with having an independent inspector general. I mean, right now, when you have the inspector general being appointed, by the head of the Federal Reserve, he is not going to call anybody out, and part of his remuneration is also based on a bonus system. So he's not going to be calling out, to the extent that he should. So that is certainly one of my recommendations. And that has to—
Wait a minute. So Inspector General gets a bonus from which depends on the management by the other bodies of the Fed?
It's a little bit more complicated than that, but it's based on an average of various executives at the Fed, I should call them senior level. And so they get bonuses. And so that spills over into what the Inspector General has. If you watch, in fact, the congressional testimony right before I delivered in mine, this was one of the most eye-opening things. That the minute you hear that his salary is favorably influenced by the bonuses that people—
Whose testimony was that? Sorry.
Problem.
Whose testimony was that?
This was the Inspector General.
Okay.
Of the Federal Reserve, and I can certainly get you the link.
Yeah.
This was really so the minute you hear bonus, it's like, wait a minute. So it's based on the average of these individual salaries and their bonus. Well, then, of course, you're not going to be the person who rocks the boat, because if their bonuses goes down, so does your $300,000+ a year salary. So that's a big place to start right there, is to have a different system where you don't have the Fed or any regulatory entity appointing its own Inspector General. That's a very serious issue to change. But you have to change remuneration at the banks, and there has to be consequences for these CEOs that cause their own banks to implode.
Stephen?
Yeah, I would just say maybe somebody should be fired, maybe not. It would be very Washington, though, to fire somebody and sort of use that as the scapegoat and wipe our hands of this. This again goes back to sort of the high level big picture, which is, you can fire bank executives, you can fire supervisors, and then it turns out the next crisis, the same incentives exist, for banks to make money and for supervisors to not enforce. So maybe somebody should get fired, but that's sort of a red herring in my opinion.
On that note, this is not the end of the debate, because in a way, every new session on this issue raises new questions that I think need answering. So thank you so much, Mayra and Stephen, for doing exactly that. Our next session will be a bit different. On September 6th, I will host Charles Goodhart, a towering figure of the analysis of banks and central banks and monetary issues. who has a very challenging paper together with Rosa Lastra, who appeared in the series recently, on whether we should re-examine the principles that banks should have limited liability as joint stock companies. So, or maybe that limited liability should be expanded. We'll discuss that with Charles Goodhart and Vera Lacharya on September 6th. And in the meantime, again, many thanks to Mayra and to Stephen, to the engaged audience, and have a great rest of the summer in the meantime. Thank you so much.
Thank you.